Hello, future billionaires. Welcome back to another episode. We've got a great one today with our good friend, Josh McCallen of Accountable Equity. And today we're talking about how to think differently in your investment philosophy and invest like a family office.
Now, what's a family office?
Well, you got to listen to the episode to hear more about it and how they actually invest differently. But there's a couple of things that are pretty distinct than a lot of kind of retail, traditional just investors. So be sure to check this out. We hit on family office. We also talk a little bit at the end of the episode about resort
Is
investing.
hospitality dead? Is it dead? Or is there some niches that can make you some real money?
Yes. And as always, we have to give a disclaimer for anyone that we bring on this podcast who is raising capital, has open opportunities for investment. Please do your own due diligence. This is not our way to promote them. We have no business relationship with them. So do your own due diligence, and hope you enjoy this episode. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Welcome back to another episode of Invest Like a Billionaire. I am your co-host, Ben Fraser, joined by fellow co-host
Bob Fraser.
And today we have an awesome guest, a friend of ours that we know from afar and see periodically, Josh McCallen, and just super excited to have him on today. So he runs a really cool podcast called Capital Hacking, if you've not heard that or seen that, and is the CEO of Viva Me, make sure I say that right, hospitality, and has really carved out a cool niche in the hospitality resort investing space. And so I wanted to bring him on, talk a little bit about that. And then also been talking recently about his kind of personal investing philosophy and strategy and really investing like a family office. A lot of these families think differently than the average investor. And it really aligns with a lot of our, thoughts around investing like a billionaire. So Josh, thanks so much for coming on.
I'm so glad to be here because you guys have one of the best branded shows on Apple Podcasts. The Invest Like a Billionaire show is dominant, man. Congratulations, you guys. You're doing a great job.
Hey, thanks.
And what is capital hacking? That's kind of cool.
Oh.
So what does it mean?
So, there's like dissertations. I'm writing a book on it, but generally I like to think of it as a couple ways. One, human capital meets financial capital. Really, we got to invest in the people. And I always talk about human capital meets financial capital, and that's really the whole idea of capital hacking. But I also love the double wins. You kill two birds with one stone. So a lot of times when we make an investment or build a company, I call it capital hacking because one domino knocks over the next, which you see a lot as you get momentum in business. But if you're intentional about it, you can line up more than one domino. I can explain that some other time.
Cool.
And then we get alternative. It's really an alternative investment mastermind. That's what capital hacking is, because you got to find assets that are outside the norm, because then they come with two benefits, right? Yield and sometimes great tax strategy. That's a good capital hack, right? Or how about yield, tax strategy, and fun? That's another great triple. That's a triple bird.
Okay, we're into that.
Well, Josh, tell us some of your story for those that don't know you, don't know your story, and how did you get into this alternative investing world and space and in the particular niche you're in?
Yeah. Yep. And I appreciate Aspen Funds and teaching me a lot. I've watched you guys at all the conferences, and we share a lot of similar values. So our journey began as a blue collar guy. My mom was handicapped, and so we kind of grew up really poor, welfare for a long time. But I love to work, right? And this is that human capital part of our show is like, you want to surround yourself with people like Jim Rohn said that are going to be the average of what you want to be. I always was working. So I ended up getting to the right rooms, and it just was a hustling, everything from paperboy to pizza guy. But journey from that to wanting to do ministry. So I ended up getting a theology degree and a history degree, and I teach. And from there, I realized I was supposed to go into business. I was supposed to go into business. So my wife's like, well, if you're going to go into business, you better get an MBA for free by going to work at a university. So there's another capital hack, right? You don't have to pay for that MBA. So that journey got us back into university. And from there, we got a crazy opportunity to live in Europe. So our journey is kind of weird, right? It goes from this heart for others to let's make sure we're making enough money to have a family, to somebody offered me a chance to live in Europe for 4 years and run a property and a campus and a hotel. And Melanie and I jumped on it when we were in our 20s. And that really profoundly kind of changed our trajectory, and a passion for beauty, a passion for others, and bringing that kind of the qualities of what we lived in Europe. We lived in the Alps in a village,
wow.
Hansel and Gretel style. I mean, it was awesome. It was like baskets. People carried wicker baskets to go grocery shopping. I mean, and I'm not kidding. It was just that good. A babbling brook right down our road. And it's so good. As a matter of fact, a lot of the cool things we do at the resorts now are inspired by our time outside of Munich and in Italy. And we would do a lot of trips. So we brought a lot of that kind of community culture to our resorts.
Man, I'm going. You have to tell me where
You'd
these
love
things
it,
are.
by the way.
I can't really see you hauling a wicker basket around, but maybe.
I'll tell you, I'm not sure it's as good as it was when we were there 20 years ago, because back then it felt like idyllic. And then sadly, those countries became extremely authoritarian under the COVID. So I'm not even sure I want to go back, but when we were there, it was like hundreds of years ago. It just felt like you could walk to everything. You walked to a restaurant, and we brought that kind of walking garden-esque kind of thing to our resorts. But fast forward, end up having a lot of kids. And so from that is also necessity is the mother of invention, right? So we're always working on building things. We started working for a family office, as we were just you and I were talking before the show. I ended up stumbling into an opportunity because of, being hustling and working to work for a gentleman who had just had a major liquidity, which he then turned into a family office. I had never heard these terms. This is like 15 years ago. And his idea was to build flip houses, about $5 million, $10 million flip houses. And at the time, I was passionate about that idea, had not yet built a house. And so he assigned me to be the project manager, to manage the family office's assets in construction. And from that became quite adept at building, because back in the boom of 06, 07, the contractors who said they were coming never came. And then other contractors came, and then your GC didn't show up. So if you're the project manager, you're the ones holding the plans. You end up just teaching the guys how to build, because it was like the Wild West back then. So I ended up building a bunch of beautiful, legendary properties. And then later, that same skill became how to get us out of a hole. He had bought a few hotels, and they were upside down financially. And it was 2010, 11. It was still a recession. And he said, what should we do? And I said, why don't we restore them and become hotel flippers? And therein lies the beginning of a long journey that got us here 10, 12 years later.
Talk a little bit about your experience in the family office, because you alluded to that at the beginning of the show, of how they think differently, right? So a lot of times, for those that don't know what a family office is, it's generally a family member or a family has some type of liquidity event, either usually from a sale of a business or an inheritance or something, and they have a large sum of money and they have to go and invest that, and hopefully that will last for many generations. And so talk a little bit about your experience there. How did that maybe change or form your perception of investing that's different than, the real estate entrepreneur is just trying to make a buck doing a flip or two? What's the difference?
Thanks for asking. Great experience there. Spent 12 years, actually ended up becoming their partner in some projects that they owned. The way that mindset can work, every family office is probably built a little differently. You guys probably know Richard Wilson from the Family Office Club. I'm sure he knows Aspen Funds. He just spoke at an event last week, so I got to hear his explanation of a family office. And he talked about, you're going to put a lawyer on your team that makes sure you sign the right kind of contracts. You're going to put a deal generator, somebody who goes out and finds assets to buy. And then you're going to put a financial planner that makes sure, you get my point. You're going to really be planning out through cycles, not typically flips. And so that general thought of, I guess, two things. One was that we felt that we could asset manage and direct manage some projects. I think I learned that from the family office. That you could actually be operators of some, asset managers of several. And I know you guys have that experience too. You have deep expertise in some of the businesses you own and run, and then you also asset manage other things. You guys do that really well. In a way, you're performing the functions of a family office for people that join your group at Aspen Funds.
Right.
You know, they can utilize you as a sense of like a plug-in for part of their needs. We do the same with our accountable equity group. So I think horizon is one of the bigger things. Horizon of yield, meaning not just pick up 50% right now. Let's pick up double digits for the long term. And then the second big thing was security. Let's make sure it's capitalized, not not thinly capitalized, but firmly capitalized so that there's enough working cash flow, working operating investment so that we can weather struggles, we can build out something. I think the other thing entrepreneurs forget is that early on in any business, you don't throw off cash that month. You don't throw cash that 2 months. I mean, unless you're buying something that's completely done growing. So say you jump right into a big asset that is already done, it's reached its peak, you're paying full price for it, but you are getting a check that month. That is one way to invest. Another way to invest is to buy something that needs to grow. You might buy at a reasonable price, but the growth period needs capital, and it needs to be patient capital. And that's a big hallmark of family office thinking is generational wealth building.
But so long-term thinking, long-term planning, not focusing on short-term cash flow, and
For protecting
Yep,
capital,
those are-
it sounded like.
and keeping
I mean,
capital in it for a period of time. Yep.
Yeah.
Yeah.
I mean, a lot of what I think people get caught up in, especially in this kind of private equity, alternative investing world, is they're just chasing the biggest return that they see, right? Marketed. And, 25% IRR projected, and
Yeah,
it's okay. Well, what is, comprising the assumptions of
correct.
that return?
Exactly.
And how much risk are you taking to generate that return?
Exactly.
Right. The number one rule of investing, according to Warren Buffett, don't lose money.
Yeah.
The number two rule is don't forget rule number one, right?
As guys who sponsor a lot of deals, I mean, you realize those headline return numbers, I mean, they're just entries in a spreadsheet
Oh yeah.
backed by assumptions. And so it really matters who's generating that, who's designing that project. And, when we put together deals, we look at all the risk profile, which the debt stack is a huge component of that. And there's lots of other things. We're looking at a deal, development deal, not entitled. Well, huge risk around not getting entitlements for, great returns. But it's like, well, not entitled. You could end up with a, 200% return, or you could end up with a zero, a white wall, face plant. And, so yeah, underwriting is a big deal. And so basically really doing a good job with the risk side is something that, we do for our clients, but it's something that few retail investors, I think a lot about. And family offices are going to obviously think that way. Yeah.
I think another point to your comment on the horizon is you get to take advantage of the eighth wonder of the world, right? Which compound interest, according to Albert Einstein, is the eighth wonder of the world. And compound interest is actually pretty boring, right? And it takes a long time to actually be meaningful. And
Right.
and so doing those maybe more boring returns with a longer time horizon, compounding, protecting capital, growing, using those points of leverage in the business or the real estate or the strategy to continue to generate more income. All those things add up and over time are very, very powerful.
So it's I think a lot of investors are chasing the short-term buck, right? And the truth is, okay, and here's a guy who's been around a while, right? And I think, this is my like fourth cycle now, and the truth is the real money is made when you're buying the bottom of a cycle, right?
Yeah.
And
Takes a lot of courage, right?
it takes a lot of courage. So when everybody's terrified, right? As JP Morgan put it, when be greedy when there's blood in the streets. Now that's, kind of visceral, but literally when people can't dump their assets fast enough, when it's, everybody's terrified, and literally you invest and all your friends look at you and say, you're an idiot. You're going to lose it. That's when you make the money, right? When there is no good news, nothing's working, it's all going bad, and you're buying. and now we're seeing, kind of clouds on the horizon. And to me, this is a time to start generating, getting some liquidity, and to begin looking at opportunistic buying, because that is where the real money is made, right?
Yeah.
And buying at the bottoms, and it's hard to do. Investing is emotional, whether you want to think it is or not. It's an emotional thing, and prices are emotional, right? So I was talking about Amazon, back in 2000, I can't remember. I think Amazon was like $50 a share, dropped to 30 cents a share a year later. Same company, same market. What happened? It's pure emotion. It's pure sentiment, pure emotion. Everybody was sure that the internet was a crock, right? And well, it's not. And 30 cents a share, so buying Amazon at 30 cents a share is a sure way to get money. What is it now? I don't even know, but so having a long time horizon is really one of the keys to true wealth creation.
Right.
And, well, good stuff, man. So
very billionaire thinking on your part there.
All right, I have a question. So Josh, how do you implement these kind of philosophies in your own business, right? Because
Sure.
as sponsors doing deals, there's always this inherent tension of, well, one, you want to show a good return to get people excited about a deal. And then two, it's really hard to sell people on a long time horizon, right?
Yep.
If you see a deal with a 10-year time horizon, people can't wrap their head around that. What am I going to be doing in 10 years? We had a deal right now where we're targeting a 5 to 7 year time horizon. And, that's a little bit of a stretch for some of our investors. And one guy we're talking with is like, well, I'll be dead by then. So I can't invest in that deal. And it's, he's being kind of tongue in cheek, but it is inherently difficult, I feel like, for people to think long term. So how do you implement these strategies in your own business plans? And then how do you get investors to kind of understand the, benefits of that?
Thank God you're asking the toughest questions. I want to share with you some thoughts we've come across over the last few years. So originally, our philosophy was a 5-year BRRR, those BRRR things, where we're going to pull the money back out and have it back into the investors' hands. We always envisioned keeping our partner investors in for the infinite returns after that. And we always planned on making their preference payments meanwhile. So our initial business plan was good, and it allowed for nice high annual preference payments, which we've always honored. And then if the economy hadn't switched so much, we would have done a normal cash out refi probably next year, right? That would have been the horizon for some of our assets. We just gave a talk about legacy asset investing as a strategy. And what we're finding is when the business is still growing on a hockey stick, we love being transparent with our investors. We say, hey, if we were to execute the strategy of just pull all the cash back out, what cash and capital would be used to pick up another 20% growth the next year and the next year? We're, that's a philosophy we're encouraging all of us to go on a journey. So now we're talking to a lot of investors, and we just did a presentation on this, that we see that it's important to let investors be their own natural selves. And some investors want liquidity. Others actually do not want their capital back as long as it's producing great yield in a great asset. That is a mind bender. So if you're listening to this show and you've never raised $1, the epiphany that we've had over the last 4 years is not all investors are cut from the same cloth. There is definitely the investor who sees 20+% IRR and thinks it's the truth, or thinks it's doable in any market turn, right? Maybe it would have been doable in a peak market, but probably not going to be doable in a downturn. But they see that and they say, that's what I want. And then there's others that say, I want cash flow annually. And then I've come to realize there's others that want peace of mind with their sponsor, right? And we have a blend of all of them. We have hundreds and hundreds of active investors, all accredited. We're honored and blessed to have 3,000 plus people read the emails, 330 have written checks and invested. So what we've learned, we've implemented. So some of our investors, we say to them, would you like to join us for the long term? Buy the equity, please. We will make our annual preference payments. Of course, if there's any downturn, we'll pause, but we've always made them. Then we say to others, we also have a capitalization model where you can put debt on our property in a collateralized debt fund, which has liquidity calls. You can call on that liquidity, similar to you guys. You do something like that. And then we have another asset class we created years ago where we build a private leasing company called an efficient income fund. And it allows investors to benefit from the accelerated depreciation program. So instead of us borrowing to buy anything that makes our businesses work, remember we have golf courses, we have tractors, we have kitchen equipment, things. Instead of letting Bank of America take a lease on us and make double-digit yield, why not give that yield to our investors, but then also design it so they get full depreciation? So we do those types of models. I worked with some great CPAs to build that. So those people, what are they getting? They're getting monthly checks at very high amortized levels, and they're paid out, and their preference is fully paid plus their yield back, their principal back in like 3.5 years. So they're big cash people. I want a lot of money every month, and I want the tax strategy. The debt people are a nice check every month, and then the equity people are the long haul. By designing that, I think what we've done is speak to the different needs. I have some investors that buy a little bit of each, and it's probably because of where they need their money to do some business. So then we go back. Now, our core business today at the Accountable Equity Group, which is a long-term, it's kind of like an Aspen Funds. It does look at other partnerships and joint ventures eventually. But today it primarily does its core skill, which is this resort turnaround, which we're buying them well below replacement, like a third to a quarter of what we buy in the value in replacement. That's what we pay. We're spending the money on them. We're building them so that they're premium, and then we're filling them with wedding contracts. I know that for us on Invest Like a Billionaire, we're talking about the bolts of what we do. That is not the fancy stuff, right? I'm not saying how pretty things. I'm just saying charge a lot, fill it up with wedding contracts, gives us an 18-month contractual revenue cash flow, and then we can weather all the ups and downs. We've weathered, of course, we did it during the pandemic, and now we've weathered this new inflationary period. And we're weathering whatever recessionary risks we have because we've already sold into 2024. I love it because it helps people realize they're buying a generational cash flow machine, but they already can kind of see next year's budget. I want to go back to family office for a minute, and then I'll answer any question you want. The other thing I saw about family office, this took a few years of working with that gentleman. So I worked with this gentleman. He had sold a massive company, and he said, I'm never going to have an operating company again, right? I want to just buy flips or things that don't have staff. About 6-7 years into building his family office, he realized I need an operating business, and I need also real estate passive, and I need real estate active. So he kind of ended up building a portfolio, and I watched him. And what I love about, I'm excited about what we're in the middle of our niche at Viva May Hospitality is heavy duty real estate, hundreds and hundreds of acres under management. Each property averages 200 acres. Land development rights are not in the pro forma, but they all have land development rights. So I love having those little Easter eggs for the future, but they're robust operating companies. So what is a robust operating company? Why do family offices put those in there? That's where you can design your tax strategies really well. And so what we do is we take all the generating tax strategies, annual depreciation. Anytime we buy something, build something, we rapidly depreciate it for the investors there. But we also have, like I said, the leasing company. We basically we stripped out piece by piece each of the great benefits a family office wants out of an operating company that has real estate basis. And we portioned it off into these tools. I think I explained that okay. For you guys, you probably see what I'm saying. Basically, we harvested out the best parts of everything: collateralization, depreciation, all these pieces. And the investor who needs whichever piece, we designed a way for them to have it. And then the rest of us equity people got the remaining balance of that. So really tax efficient, ongoing business. And that's kind of the summary. Now, you and I are talking like investors like a billionaire. If you and I were on a different show, I'd tell you all about how pretty things are and how we sell really well. But here, I wanted to just give you the brass tacks of how we do things.
I love that point. I think, we've talked about this a little bit on the show in other episodes, but, operating companies, especially in kind of this investing podcast world, they're not talked about a whole lot. And we've tried to talk about venture capital investing, private equity investing, which are into businesses, not just real estate, right? Because most of these family offices, most of these ultra wealthy have become so because of operating businesses.
Correct.
And you're looking at a cap rate on a multifamily property, say you're at, 5% cap rate, that's a 20x, net income multiplier. Well, for an operating business, if you buy a mom and pop, you can sometimes get a 3 or 4x. So that's, a 25 or 33% cap rate. And so you're taking more risk. You a lot of times don't have the same collateral, but it's a way to generate value. And if you're buying these properties that, have levers where you can kind of push the top line, you can, make them more efficient, That's extremely powerful.
Totally right. I
Yeah.
mean, people
Yeah.
don't think about Warren Buffett, but Warren Buffett has made all of his money by buying operating companies, right?
Right.
And the returns, they are better. I mean, it's not, most businesses are generating 15 to 20% cash flows and profits on their value, and so it's much better than just assets. He doesn't own just piles of assets, and
Right.
so the returns are better. Yeah, it's riskier, and yeah, you have this ugly thing called people involved. But
Ooh, that hurts.
yeah, people, but are they really ugly, right? I mean, that's tongue in cheek. It's a lot of work to manage people, but if you're good at it, you can make outsized returns, and so it's definitely something that key strategy for deploying capital, especially as you're growing.
May I share something about that, Bob? You said it right on point. And at the onset of this show, I guess I was extremely enthralled with the idea of how intellectual your group is, how deeply you've thought about the future of how America is going to increase in manufacturing, and inflation has a strong foothold. I mean, I've been following your work, but I want to just go back to one other thing that's important to us, people, and that's our heart. And there's also something to the fact about people and jobs and purpose in life. We find it beautiful, right? And so at the end of the day, somebody laughs at my LinkedIn page, but it says I'm investing in real people and real assets. That's pretty much all we care about. People that want to be honest with themselves and with others.
Yeah.
We say, so what we're doing at our company that might help color that word people is we're seeing them as someone to be invested in. And it begins for us, if I could just opine, Ben, I think you've probably heard me share our real heart of what we're doing with our operating companies is we are building them on something called Viva Me, which is a stylized French word that means reviving the soul. And we just believe that us as people have a spiritual dimension. We're not just the skin. I mean, there's a little more to this, baby. We all know it. It's in the side of our heart. And we want to respect that and love that in our teammates. And we think the ripple effect is powerful. So what we do each week at our team, and this is why we have so many staff, thankfully, and we haven't had staff shortages. Everybody makes more. That is part of inflation, but everybody keeps coming back to our companies because we start with 3 virtues and we say, hey, if you want to work with us as an investor, even just be aware, this is how we run our companies. We have 3 virtues. They're called the Viva Me virtues. They think they're for the soul. We say, we don't want anybody on the team. It's a way to say, please attract the right people, not the wrong people. Do you seek to serve with joy? Whatever your role is, joy of service part of what you want to grow in. 2, do you want to grow in humility? Because humility is the identification that everyone has infinite dignity and worth. And we're going to treat people that way. We're going to demand things, right? We're not pushovers here. We're going to demand that we do our jobs, but we believe that they have that same dignity that you have and I have. 2, and then the third one's a unique one that we've been working on for years. It's called ministry. And we ask everybody, do you want to grow in the virtue of ministry? And no matter where they come from, their background, have never heard the word before, we describe it in a very simple way. And we use Thanksgiving as a good example because everybody kind of likes Thanksgiving. And we say ministry for us is the ability, and you have to work on this, to take the normal task you were going to do anyway, right? You were going to get up this today and you were going to make a podcast, or I was going to get up today and serve someone a cup of coffee, and take the same work and do it for someone's spiritual good. And the simplest spiritual good is so they know they are loved. And so can we do this delivery of a delicious meal, not just because we were told to deliver the food to the table, but can we do it so when we give it to them, they know they are loved by us?
Adding a dimension of higher purpose.
Adding a dimension
onto your work.
It's so powerful.
No, it's so cool. I mean, going back to the operating company piece of this, it's a way to actually have impact, right? Because you're providing jobs, and impact investing is something that, doesn't always pencil because, if you're giving up something or doing something that maybe is not purely for the bottom line, there has to be another reason for it. But it's a cool thing to do. If you have an operating company and it's growing, you have the ability to provide jobs and you have the ability to create a culture and to create a place that people have purpose and can come and enjoy what they're doing. And so there's the pros and cons. You have to want to do that, right? That's a lot of work.
Takes energy.
It's a lot of energy. But it's a powerful thing.
So I'm going back to your family office guy who said, hey, I want to invest, but I just don't want to have people involved, right? No staff, right?
That was his original idea. That was his original idea.
But I get that because people are of work, right? But people also generate a lot of value, or they can. They can also generate a lot of problems, right? And it's really up to your skills. So for us as leaders, it's let's throw ourselves at that, right? And let's become great at managing and leading people. And you do get outsized returns, you know. I think it's especially challenging in this environment, and we're seeing, demographic changes across the planet. I've been highlighting, I think in the next 30 years, 45% of Chinese population will be retired, right? It's the fastest retirement and fastest aging population ever in history. And so that means you got one person working for two people consuming, one person working for two people, going to restaurants and hotels. And so we're going to be having enhanced worker shortages over the next generation. And it's in every industry and it's in every country. It's actually not as bad in America as it is in virtually any other country, but worker shortages are going to be a part of the equation. And what's more, you've got this the demographic changes where, automation is removing the lower end jobs, and they have to be, but you've got so you got this really weird system where there's lots of worker shortages coming, but especially knowledge workers, right? Because so the lower end is just not going to be, there's not going to be a lot of workers, and there's not going to be as many jobs either. And so very interesting to solve the people problems for a business is really the people who can do that are going to be the ones that make a lot of money and have outsized returns. So. Good on you for
we got to pioneering
something.
You even said it though, even at the knowledge level. You're right. Most of our teammates get to actually work with their hands. Not everybody, of course, but even at the knowledge level, Bob and Ben, it seems to me, just as a very simple view of the world, that one of the struggles today is people don't feel that there's a purpose, right? And so we're making a small dent in that. Even if you're a guest at one of our resorts, the expression on the lips of everybody as you walk in is "welcome home," because so few people have connection in this world. So we're trying to be, in each little way we can, intentional about that. And I think it's kind of the more you can do that in your own companies, whichever company it is, the more you'll stand out. And we're going to fight that fight.
Let's talk about hospitality space for just a minute. So you have 3 large resort properties, and it sounds like your growth is just accelerating. And I've not been necessarily bullish on hospitality. In fact, staying away from it, pretty clearly. So blow me up. Why am I wrong? It looks to me like everything's been COVID definitely made hiring hard, made staffing hard. It's kind of a feast or famine in the world. So some of the hotels are doing super poorly, and some are doing super well, and then it's staffing related, which is
Correct.
Really a problem. So I'm telling everybody stay out of hospitality. So blow me up. Tell me why I'm wrong.
Yeah, I mean,
why are you guys making it so good?
There's truth in what you're saying. We always came up with this years ago. We started buying those beach hotels was the ones we started with 12 years ago. And beach hotels in the Northeast kick butt for 3 months out of the year, like unbelievable amounts of money. And then they suck wind for 9 months out of the year. So, some people do all these crazy ways to try to operate that. And we came up with the philosophy that we wanted to invest in the people to stick around. So we created 9 months of active selling. 3 months of taking the gravy train and 9 months, of working your butts off. Okay. So that discipline for 12 years now has made us a juggernaut. I think we're kind of in a very powerful sector of hospitality where we fill our own book. And that's different than what you might be familiar with. So most hotels depend on Expedia, or they depend on, you can't book a room at our hotel for the next 18 months. Okay. So we're sold out for 23 at a price that's double to triple the average rate of all of our neighboring hotels, because we're not in a city, we're in a rural setting, and we sell contractual weddings. Now you think, oh, everybody sells weddings. So we performed 364 weddings at one property this year. And we, on top of that, did a total of 1,000 events at this property, catered, contractual, money in advance. So there's just a different way we do it. We fill our own pipeline, and we do it through great marketing, really focused on sales, and we have the best products.
Event related?
Yep. So it's hard to grasp our sale.
Really an event business.
It's versus a classic hotel business.
Yeah, yeah, and that's actually a funny. I find that to be a massive positive. But you're right. When people try to put us in a box, they're like, "Well, you're not just a hotel." So to give you a great synopsis of the company, I just told you how strong we are at catering. This year we'll do 21 million in our second full year. We budgeted to do 10 million this year. We'll do 21. And that was just a 2-year turnaround from what we thought we could have done this year. And the way we did it though is 12 million came in from catering. So you're like, well, where the heck did the rest of the money come from, right? There's a waterfall effect, a capital hacking effect. Whereas once we have Uncle Louie and Aunt Sally here for the wedding, they're probably going to buy some things in our cafe. We have a Parisian cafe. They're probably going to buy some things they're probably going to play golf. So this waterfall effect is so powerful. And then each one of the waterfalls, hotel, restaurants, we have multiple. The scale is hard for anybody to grasp. You'd have to look it up. It's called Renault Winery. It's a resort. It's an East Coast legend. It's hard to believe how big it is. 5 ballrooms, 12 other meeting spaces, and it's been open for 158 years straight. That's another cool thing that's very legacy-esque. So bottom line is all those waterfalls filled up because we sold out the building. And that's the difference between us and traditional hospitality, I think. Most hospitality is relatively transient and very vulnerable. And so we're not built on the 2 major problems, transient tours and business. Now, we love business travel, but we don't have it in the budget. We have 0. So anytime we get a corporate conference, it's all accretive profit.
So there's no recession
basically
in
how to do
weddings, right?
There's no recession in weddings.
People are going to be
Never has been.
getting married and having babies, regardless of what the economy is doing, and maybe a little more modest in the budgets. And so it's very interesting. I do like events, and it seems like there is a massive shortage of event spaces. And
apparently there is. Thank the good Lord. To give you an example, we have 4,000 inquiries for next year already for weddings. So we sold 300 of them. And when I say we sold 300 of those 4,000, I'm talking about premium, very expensive contracts. And what's cool, sorry, this is for the geeks who are into business. We have the contract already for next year. We took 25% of the cash for next year and we put it's non-refundable. They're called contractual fees. They're not just deposits.
Right.
And they're pretty premium. They're like $37,000 to $45,000 a contract just for the food and beverage. Has nothing to do with anything else. No hotel rooms on top of that. So what we've designed here is a juggernaut model so that we can continue to build a portfolio in all economies.
Wow. So what is I haven't really done a lot of research, market research on events. Why are they booming so much? And is this
answers.
Is this going to continue?
2 answers. So I'll give you, these are very good billionaire questions. In the year 2018, we bought this big resort, and that year in our market, 47,000 weddings happened in this market that we pull from. So pretty good, right? Then in 2020, almost none because of the COVID and the lockdowns. Then there became a boom, a backlog in 21. So 55,000 happened in 21. Going forward, the average is now going to be 50,000 a year. So it's going to come down off the boom and it's going to level at a whole new plateau. And the basic theory is weddings are different than even generations when you and I got married. For you and I, it was the formation of a household. Today, it is an Instagram party. I'm sorry to say that and to be rough about it, but it's very much unbelievably glamorous. And for whatever it's worth, the more social media grows, the more weddings, the way we do them, will grow. I mean, if you look at our weddings, they look like they're on a movie. Yeah, they're beautiful.
I need to make sure my daughters never hear this episode because I have 4 girls and I'm already a little nervous about
You should be.
the expense line item
It
for
gets
weddings.
ridiculous. And we've sold $100,000 and $150,000 weddings. So we don't try to sell those. I mean, that's not what we build our model on. We build our model actually on like closer to 30,000, and then we average 37. Then we try to beat our models.
I love the event space. I do think it's unique, and I think resorts, as wealth increases, which it is, people are looking for better experiences,
put it somewhere.
and people want to spend for the experiences, and as you point out, the Instagram fest.
And we're relatively close to Manhattan. 80% of our brides come from the metropolitan New York area, which I always say there's District 1 is Washington D.C. The Hunger Games told me they're always going to be rich. So we have a beautiful, like absolutely gorgeous waterfront venue 45 minutes from the Beltway, 45 minutes from downtown DC, I should say. So we are always going to be able to sell that wedding venue forever. And up here in New Yorkers, as long as there's a centralized money finance center in New York, we're going to be able to, they consider us cheap, the New Yorkers. I always crack up because, I grew up very humble. Our wedding cost $4,000, I think, to do. So I'm not a consumer of this exactly at this level, but we are very good at performing.
Oh, good.
Well, Josh, what's the best way for folks to, follow you, podcast, website, if they want to book a wedding? I mean, what's the best way to?
You'll have to call me personally to see if you can get in, because I don't know if I have any more. But let me show. I got my jersey on. I wear my jersey, my accountable equity jersey. That's one great way, just accountableequity.com. And then, of course, Ben Fraser was just on the world famous Capital Hacking Podcast, episode 252. You did a great job, Ben. You did a great job.
That was fun.
And you have open investments?
We always try to keep something open. We have a debt fund. We're adding capital to the growth of these resorts. Land development options, things like that are coming. So right this minute, yes, when you listen to the show, there will be options. You just hit the website. You do need to be accredited.
Super. Right.
Josh, thanks so much. Always fun to connect. Appreciate
You're the
you
best.
coming
I can't wait to see you at the next conference.
on. All right, man. See ya. Perfect.
Good.
Good stuff. You've done that a few
Thank
times
you,
before,
guys.
I think.
Yeah. Fantastic show.
Thank you very much, Bob. I'm glad you asked the tough questions, because without a doubt, I would probably stay away from hospitality as a generic as well. I feel good about what we do, my personal guarantees on everything. And we're going to fight like a dog every day. That's the way we do it.
Yeah.
God bless you guys. Have a great day.
You too,
All
man.
right. See you, Josh.